we've seen pressure on the long-rated bonds, not only in U.S. markets, but also we've seen it in Japanese markets, right? When you and I were last together, when I was in Asia, we saw that happen on the 50-year dated bond. And so I think when we look out, I think investors are starting to reprice long-dated bonds with regard to just the rampant expansion of the fiscal deficits that we've witnessed in advanced economies. So again, the United States is not unique here. I think when Secretary Bessent looks forward to more issuance, we have seen a number of lackluster sales. And so to the extent that investors, will be asking for more money to hold these bonds, I think is a very clear perspective for this year and definitely for next year.
Unfortunately, I totally agree with Alexis. I mean, the good news is that we talk about a cut in the rate because about 4 weeks ago it was all about a hike in the rate because of the inflationary pressure. Again, we have the tariff war coming to some sort of resolution on the 9th of July when basically we know how the tariffs are going to be implemented on a couple of countries. We have to see what the delay of shipments from China into the U.S. will cause on the shelves in the U.S. We have seen no major inflation at this stage. So in a way, it's a wait-and-see situation that we have to endure in a way. Could go either way, but at this stage, I'm completely in agreement with Alexis.
Alexis, I want to get back to oil and energy and pipeline inflation potentially there. I mean, oil obviously has tanked, right? For how long, we don't know. It's starting to pick up again, early Asia right now. But, freight rates is one thing we're watching. That's important, right, to the final cost of any product that moves around the world. Insurance rates are still extremely high. What is the risk that there's still a lot of pass-through to come in energy and final prices?
Well, Marsden, actually where I want to take you is just slightly longer, which is, will we see $100 barrel of oil again? And that's where we're definitely a little bit of a contrarian perspective. Curious to hear Jorg's view too, is that, yes, we have an oversupplied market at the moment. Some of the shale tier 2 production will require $80 a barrel to come back online. So you could, if you see an uptick in price, you could again see, an amplification of the supply glut. But one dynamic that is not necessarily covered very much is the extent to which changes in structural demand can actually push the price of oil back up again. And namely, when we move from nat gas to oil for power generation. Everybody's focused on data centers. I would say the data center piece is a little bit overblown when we think about demand overall. Look at AC and cooling uses in the GCC economies. By any forecast, that can actually increase demand by 1.5 million barrels a day, oil equivalent, to 2030. So again, when we have record high temperatures, we're sitting in one in New York at the moment, we think about the residential demand that drives 28% of power generation around the world. And we think of the need to use all different types of fuel, including oil, for power generation. This could actually push us back to $100 a barrel of oil going out to 2027 and beyond. So back to your question on inflation and where interest rates will need to be held over the longer term, I think we are in a structurally higher for longer environment in the U.S. Absolutely.